Cold open. Fact 1, Part 1. Banks make money from debt primarily by charging interest on loans. This financial procedure in its entirety is an elaborate web of countless financial transactions that effectively epitomize the heart of the banking system. When we delve into the significance of interest on loans, we're fundamentally addressing a small portion of the complete loan amount that borrowers are compelled to pay over and above the principal sum. This interest is not just an arbitrary figure thrown into the mix, but is a product of meticulous calculation based on numerous influential factors such as the loan amount, the duration of the loan, the duration of the loan, the credit score and history of the borrower, the economic trends, and the current market dynamics. Fact 1, Part 2. The accumulated interest on these loans is the primary stream of revenue generation for banks. This income from interest is the driving force for their financial stability, catalyzes their growth, and ensures their survival in the fiercely competitive financial market. Fact 2, Part 1. Besides the interest, banks also generate income from a myriad of other channels. One of the significant revenue sources for banks arises from the plethora of fees. Fees are extensive and are imposed by lenders during the processing of new loan applications. These charges are designed to cover the costs borne by the bank in the processing and approval of the loan. In addition, there are penalties for late payment that serve as financial deterrents for delinquent borrowers. These penalties are not only punitive measures but also contribute significantly to a bank's revenue. Fact 3, Part 1. An intriguing facet of banking is the way banks leverage the money deposited by their customers. Ideally, a bank's customers would keep their money in the bank without withdrawing it. This idle money is then utilized by the bank to lend out to other customers as loans. Fact 3, Part 2. This cycle creates a fascinating interplay of debt, profit, and more debt. As more and more customers deposit money into their accounts, banks are equipped with more resources to lend out. This, in turn, provides banks with the means to offer more loans, resources to lend out. This, in turn, provides banks with the means to offer more loans, thereby increasing their profit margins. Fact 4, Part 1. The sheer quantity of loans that a bank disperses has a direct and significant impact on its profits. A higher number of loans implies a higher probability of gaining interest and fees. Fact 4, Part 2. The more loans a bank doles out, the more interest it accumulates, and consequently, the more profit it rakes in. It's a simple mathematical equation. However, the challenge lies in managing these loans, ensuring timely repayments, and maintaining a balanced and risk-optimized portfolio. Fact 5, Part 1. A lesser-known fact is that banks also generate profit from in the practice of selling it to other financial institutions. This may seem counterintuitive, but this form of trading debt is a critical element of contemporary banking. Fact 5, Part 2. This is primarily done in the form of securities, which are essentially tradable financial assets. These assets, often bundled together, are sold to other institutions, thereby generating immediate capital and mitigating risk. Fact 6, Part 1. Stepping beyond the world of banking and finance, let's venture into the realm of philosophy. The matrix theory, in spite of lacking empirical proof, sparks intriguing discussions about our perception of reality. Fact 6, Part 2. These dialogues delve depths of consciousness, question the nature of existence, and open up new perspectives on the human condition. The theory questions the very core of our existence, the nature of reality, and our perception of the world around us. It provokes us to think beyond the apparent, to question the conventional, and to push the boundaries of our comprehension.